Did you know that when Michael Burry correctly predicted the 2008-2009 housing and stock market crash, he was harassed by the government and had to pay millions in legal fees to defend himself? Instead of being recognized for his efforts to warn millions of Americans about the upcoming dangers, he was forced to suffer both mentally and financially as a result of the US government's suspicions. They should have made him their lead economist. This is what Burry had to say about the situation.
I saw the crisis coming. Why did not the Fed? Never did any member of Congress, any member of government for that matter, reach out to me for an open collegial discussion on what went wrong or what could be done. Rather, within 2 weeks, all 6 of my defunct funds were audited. The Congressional Financial Crisis Inquiry Commission demanded all my emails and lists of people with whom I had conversed going back to 2003. And a little later, the FBI showed up. $1 million in legal and accounting costs and thousands of hours of time wasted, all because I asked questions. It seemed they would pump me at gunpoint or not at all.
Well, today I'm getting the exact same feelings as when this played out in 2008. No one is listening to Michael Burry's warning about what is to come in 2023. The US and global economy are still facing major dangers, with the entire world economy teetering on collapse. It doesn't matter if all economists agree or not on whether the US economy is entering a recession or not, but one thing is certain. The economy and stock market are currently making no sense at all and are completely disconnected from reality. The lack of growth or even negative growth in corporate earnings is making a global recession and potential collapse increasingly more likely. Even JP Morgan recently warned that the market could fall an additional 20% from its current levels. To add to this, recently the stock market has been behaving extremely erratically, having become highly volatile and unpredictable, with some days experiencing sharp declines followed by big rallies the very next day. While many people are uncertain about whether the economy is headed for a recession, stagflation, hyperinflation, or total collapse, Dr. Michael Burry is once again standing out with his clear-cut prediction for 2023. As a contrarian, Michael Burry saw the subprime crisis before anyone else. Now, Burry is arguing that inflation will get even worse in 2023 and erase all market gains made over the past several years. The pain we have seen thus far in markets is just the beginning, with no end or bottom in sight. So let's discuss the current situation playing out in the stock market, including the reasons for the sell-off and the latest warning from Michael Burry. Make sure to stick around to the end of the video where we will cover why it is extremely likely Burry is completely correct and inflation will come back much worse in 2023, collapsing markets globally. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind. In the current trading environment, Michael Burry has warned investors to not get their hopes up about any market rallies in the winter quarter, as they are likely to be short-lived and to not ultimately lead to a market recovery. A market rally refers to an increase in the stock market of at least 5% during a downtrend. During every single bear market we have seen in the past, there has always been at least one rally of at least 5%, and rallies of 10% or more are even more common, occurring in 2/3 of the 21 bear markets between 1901 and 2015. Now, based on the current situation, it is clear that history is repeating itself. It is also apparent that the deeper the decline, the harder the rebound will be. For instance, in 1929, the Dow Jones rebounded around 48%, only then continuing on to fall 86% before bottoming. Similarly, the dot-com market crash of the early 2000s also had 8 bear market rallies of 18%, including 4 gains of almost 30%. But these were all false market rallies, with the market only continuing to go on to continue to drop lower. Again, in the great financial crisis of 2008, 9 bear market rallies of between 6 and 24% were observed before the market went on to bottom after a couple of years. Speaking on the current bear market rally, Michael Burry noted that since the market peak on December 31st of last year, there has been a pattern of falling 8 to 10%, followed by a rally of 5%, then falling another 8 to 10%, then rallying again by 5%, and so on. In a tweet, Michael Burry warned investors that dead cat bounces are the most epic and can easily deceive investors into thinking that the bottom is in. 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. He also shares, the Dow had 10 bear market rallies over 10% and averaging 22.8% before going on to bottom a further 89% down. Therefore, he's suggesting that investors should not be fooled, as it will take some time before hitting the true bottom of this current downturn. Historically speaking, there has been no bear market having bottomed without a VIX reading of 45 or more. Recent history has proved this rule as well, with the market not bottoming until huge spikes in the VIX was observed, with readings of 70 in 2008 and then hitting 65 during the COVID crash in March of 2020. In 2022, we have not seen this huge shoot up in the VIX or volatility, meaning that historically speaking, it's very likely we haven't seen the bottom yet. To accurately determine the bottom of the stock market, Michael Burry is keeping an eye on several other indicators. He points out that 13% of stocks have closed above their 200-day moving average, which is never usually seen at the absolute bottom. The bottom typically occurs when the number is closer to 5%. At the bottom in 2008, it was 1.2%, and during the crash in 2020, it was at 2.8%. Therefore, according to this metric, we are currently still far from the bottom. The only exception to this rule was the dot-com crash, which was largely limited to high-growth tech stocks. The second indicator Burry points out is there are 218 companies on the stock market with a valuation of over $1 billion that are losing $100 million per year. Additionally, there are 29 companies with a market cap of $10 billion or more that are losing $100 million annually. These companies include Uber, Snowflake, Lucid, Rivian, and Shopify, among other dozens of companies. Burry points out that before we see the absolute bottom in markets, this silliness in terms of sky-high valuations and unprofitable companies has to go. If the current trend of previous crashes continues, we may see a repetition of the pattern observed in 2008, in which the market did not reach its lowest point for another couple of years. Now, the most horrifying and pernicious reason Burry believes the market has not yet bottomed is because he believes we are going to see another huge spike in inflation like we saw in 1929 and the 1940s. Burry tweeted, "Inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell. It will be because that is the essence and nature of inflation. It resolves, fools people, and then comes back. When it comes back, neither the President of the United States nor the Federal Reserve will take credit." And the charts back up Burry completely. They show that since 1940, inflation does not occur once, but usually spikes twice before resolving. This isn't a trend that hasn't only been spotted by Burry either. Tech billionaire and investor Chamath Palihapitiya has spotted this and spoke on how the sharpest minds on Wall Street are expecting this exact scenario to play out in 2023.
Here's this really interesting setup. We have a bunch of very positive news that I think we all have to process. First positive news was that inflation ticked down. Now, here's what I'll tell you. There's a caveat here. I talked to a bunch of pretty smart sharps on Wall Street. And, two things. Number one is they all gave credit to David Sachs, and they said Sachs was totally right. Double dip recession is coming. But then they said, tell Sachs that we think that these are the sharps. We think that there's a double hump in inflation coming, which means it's coming down to come back up. And there's a bunch of reporting vagaries that may cause that. So keep that in the back of your mind. But positive news, number one, is inflation ticking down. Number two, Jason, we talked about this. A federal judge basically stayed Biden's attempt at giving student loan relief. Now, that would have been a $500 billion transfer payment from the government into the hands of individuals. It is deflationary to not give that money to people. It's effectively taking stimulus away from folks. Number three, it looks like we're headed towards a split government, which means that we are not probably going to see any more stimulus over the next 2 years. Number four, Ukraine wins in Kherson. I hope I'm pronouncing that right. Number five, the United States announced yesterday through the Wall Street Journal that they had essentially said no to Ukraine's request for advanced drones. And they said to Ukraine, essentially, you need to go and negotiate an end game here. And number six, China has started to relax its COVID policies, and Xi is pivoting to economy first. I think if you take them together, what it says is that, wow, there's the potential for a lot of great positive developments over the next 6 or 9 months. Mm-hmm. And I don't think that was adequately priced in the market. But here's the problem, and this is why we've been rallying. The problem is that most of this rallying has been because of a bunch of short covering by folks who were
pretty pessimistic and negative after the last few inflation prints. So this is not really net new buying that we saw over the last couple days. So you take it all together, I'm like, it's still going to probably trend up a little bit. But then again, we talked about this, Jason, when the VIX gets into the low 20s or the high teens, that's probably the short-term top, and then it turns around, and unfortunately, we're near the low 20s, high teens. So that's kind of my thought on things right now.
However, it's not all doom and gloom for investors, as this will all culminate in a great opportunity to buy and to add to positions over the course of 2023. Once the bear market does pivot, the average bull market lasts for on average 9.1 years and has an average cumulative total return of 476%. The Wall Street Journal recently published an article saying that the current rebound we are witnessing is most likely just a bear market rally. They, like Burry, observed that since 1990, the biggest rebounds are observed after markets have had their worst falls. Burry likens the current investing climate to a similar scenario he witnessed play out in 2000. Another feeling I'm getting is mid-late 2000, free cash flow totally on sale and ignored, while former momentum stocks are coming down but not far enough, and darling better businesses still had a ways to fall. Value was about to take off for years despite more crash on the way. Therefore, Burry is suggesting that boring businesses are the ones that will actually outperform in the short term. So this begs the question, what is Michael Burry buying, and how is he personally positioning his portfolio if he expects the stock market crash to only worsen in 2023? Well, during times of economic crisis, the companies that suffer most are usually those that society doesn't need in order to function. For example, companies like Facebook, Twitter, Amazon, Snap, and Microsoft may be extremely profitable most of the time and provide services that most of us want, however, they're not exactly services that society needs. As inflation and economic conditions deteriorate in 2023, people's spending habits will shift, resulting in less money being spent on non-essential goods and services. This is why technology companies have been particularly hard hit over the past year or so and have already begun experiencing mass layoffs, with hundreds of thousands of employees being fired. But no matter how bad the economy gets, there are services society will always need to continue to function. Things like energy infrastructure, social services, and prisons. And in his most recent 13F filing, which must be submitted to the SEC quarterly and reveals an investor's holdings, it was disclosed that Burry's portfolio has been heavily focused on essential services such as prisons and telecom companies. Currently, 2/3 of Burry's total portfolio consists of these real asset companies, whereas in the past it was heavily concentrated in non-essential service companies like Meta or Cigna. It is clear that Burry's significant shift in portfolio is due to his belief that non-essential products and services will continue to decline in value in 2023, while value companies and essential service companies that support the basic functioning of society will become more valuable, or at the very least maintain their value. Obviously, this is a simplified explanation of what could be driving Burry's thought process and why technology companies are experiencing such severe losses in value. However, as a general rule, this trend tends to occur during major crashes or recessions. When economies start to struggle, people tend to reduce their spending, which leads to less income for non-essential companies. In summary, the main focus for investors in 2023 should be on finding ways to increase their income as much as possible in the next 12 to 24 months. This way, even if the market continues to decline, they will have sufficient cash on hand to take advantage of lower prices.